Hello, welcome to today's section. Today we'll be looking at how to mark the high and low of the market. So whenever you want to enter into a trade, you open your chart and you have to do your analysis before you take a decision whether to buy or sell. Now, but before we continue or before we dive into today's video, I would like you to do me a favor by hitting the subscribe button. Also, don't forget to leave your comments at the end of the video. If you have any question, any clarification that you want, you can leave a comment so that I'll be happy to attend and respond to your questions. So without any further ado, let's get straight to the main topic of the day. So looking at this market right now, today's video, we are just going to mark the high and the low of the market. So we are looking at USD JPY, that is US dollar versus Japanese yen, and we are on the daily time frame. So for you to take a decision on indicating the high and low or market high and low, you have to come to the higher time frame so that you can see the clear direction of the market. You can come to the daily, 4 hour, 1 hour, or even you can even go to the weekly time frame to indicate the high and the low. So what you have to do at this point is that let's start from this angle. Let's start from this point. This is, let's assume this is where market is currently, this high, and this is the high that the market has reached currently. So what you have to do to indicate the low is that you have to move to the left side. The left side. So when you move to the left side, you will see that the lowest that it has gotten to is this point. The lowest, because this low has broken this. So we'll take another line, indicate our low over here. So see, the market was moving from this direction. The market was moving from this direction, right? So we assume that this is where we've gotten to currently. So what we do is that I put my first line here. Then the second line, before I spot the second line, I have to trace it backward to the recent low. So the recent low is this one. So as we all know, market does not move in a straight line. No, it doesn't happen like that. Markets move in up and downs. That's markets move like this. To spot every market, markets move like this. It creates a higher high, higher low, higher high, higher low. It moves. That is what makes it very difficult to predict. You understand? So market does not move in a straight line. No, it moves. It creates higher high, higher low, higher high, higher low. So what we are talking about here as higher high and higher low is that when you take this market, for instance, you have this. Let's assume you have this. So this point here is a high, and this point here is a low. So when this got broken to the upside, then we call this one higher high. It's a higher high of this one. Then this one becomes a higher low of this one. So this one got broken again. This becomes a higher high, and this one becomes a higher low. The reverse is for a downward. This is for an upward market. This is for an upward market. The reverse is for a downward market or a bearish market. So let's assume you have this. Let's assume you have this for a bearish market. So you can see that from here we have a higher high, a high over here, then a low. So this one become a high low. Then this one become a lower low. This one become a lower high. This one become a lower low. So it goes in that direction. I believe you got my point now. So the market doesn't move in a straight line. What you have to note is that the market doesn't move in a straight line. So the first thing you have to do is you have to be able to identify this high and these lows before you do anything else in the market, before you take your decision in the market. You have to be able to spot the high and the low. So let's take this chart for example. We are taking it from here to here. So one thing that you have to note is that when we are marking high and a low, we use the wick of the candle. But when we are considering a break of the high or the low, we consider the body to close below the previous high or low. Don't worry, when you get to a point where we've had such a situation, I will let you know. So looking at this, you will see that the low here got broken here. So this becomes our new low. This become our new low. Then the high still remain. Remember, I told you that we trace it to the backward side. So the high still remain where it is. Now, when you move on, you see that the low got broken again. So we have to move it to a new low. Then we trace the high. The high becomes what? This one. So we move our previous high to a lower high because a lower high has been created. So remember, when you are spotting this, meaning that you are determining the direction, overall direction of the market. The market, meaning this market is moving to the downside. So as you can see, the lower low has been broken again by a candle. The candle has closed below it. So we move it to the low here. Then we trace to the left, we have a new lower high. So we move the previous lower high to a new lower high, which has been created over here. So looking at this, you could see that this candle did not close below this. It is only the wick that close. It is only the wick that is below the previous low. So with this situation, we do not consider this as such a lower low, because what I want to see is that I want to see the body of the candle closest below this line. So if the body of the candle closes below this line, then I'll move this thing here. But since the body does not close below the previous low, I will not consider it as what a break of that low. So I would have to wait to see what happened. Now, as you can all see, it has broken over here. So we have a new low over here. So we trace backward to determine the high that caused that low to break. So as you can see, we have this high. We have this high. So this is it. We've been able to mark the high, the lower low, the lower high, the lower low, lower high, lower low, lower high, all the way to the down here. So what we are going to consider over here is that we are looking at this to wait to see if it's going to break to the upside or to the downside. So remember, as you are marking these lows, you see that they are moving to the downside. All you are considering is what? A sell position. So you want to wait for a pullback, then you look for an entry for a sell. We will talk about entry in subsequent videos, but today's video we are only focusing on how to mark the high and low of the market. So let's look at this. When you go to this point, you realize that The lower high has been broken to the upside. So we move our line to the new high that has been created. Then we trace it backward to see the low that caused that. The low that caused that is this one. So we move our lower low towards the lower high, which has been created over here. Now, we wait to see what happens. Now, it has come all the way to the previous lower low. But remember, we said the body has to close below the line before you consider it as what a break of that low or that high. Now, since it has not broke the previous distance, we have to consider it to play out. So we wait for either for it to break to the upside or to the downside. So over here, you can see that there's a broken to the upside, creating this new high. Then we'll trace it backward. Now we can see that this is the low that caused that move. So we have our new lower high. Then all of a sudden it has been broken again to the upside. Then what is the low that caused that? This is the low that caused that. Then we mark it. Now all of a sudden this low has been broken to the downside. So we have our new low and the high remain as where it is. So you have seen how we've been able to spot the high and low of the market. Remember, you can do this on the lower time frame, the higher time frame. Any time frame that you are trading on, whether you are day trader, swing trader, or the day trader, you can do this on the lower time frame, the 15 minutes, the 1 minute, and the 4 hour, the 5 minutes, all of them. But the most important thing that you have to note is that the higher time frame confirm the overall bias of the market. The higher time frame confirm the overall direction of the market. Now here, the market is moving to the upside. So what you want to consider is that all you are thinking about is opportunity for you to buy. You are not thinking about selling because the market has changed direction over here as it was coming down from this angle. As it was coming down from this angle, it has changed direction over here to the upside. So from this point to this point, you are considering a sell positions, a sell position. Now, how do you determine whether to change a bias over here to the upside? You would have to wait to see what the market will do. So if the market break this low again, then definitely you see that every low there's a pullback. Every low there's a pullback. So this is it. Every low there's a pullback. Every low there's a pullback. Every low there's a pullback. That is how it works. So this one, it has a pullback, but did not break this one. It did not break this one. All of a sudden, it broke to the upside. Then that should tell you that the market is changing direction. But that is not the main topic for today. We'll do that in another video. But I just want you to have a fair view of how the market work at that instance. So that is it for today. But before we end today's video, please do me the favor by hitting the subscribe button. Hit the bell icon so that the next video that I'll upload, you'll be the first to note and be able to follow as we learn. As I said earlier, always consider the higher time frame before you take a decision on whether to buy or sell. So thank you for watching today's video. See you in the next.